All right, welcome to The Explainer. You know that feeling, right? You're watching the news, you see some crazy headline about a war, or trade tensions, or just political chaos, and you feel that knot in your stomach. You start thinking about your investments. Well, if that's you, you are in exactly the right place. Today, we're going to turn all that uncertainty into a rock-solid, concrete plan.
I mean, you see these headlines flashing across your screen. A new conflict pops up. A sudden policy change gets announced. And you can't help but wonder, what does this actually mean for my 401k? For my family's savings? That feeling of being powerless, that's exactly what we are going to dismantle today. We are moving from anxiety to action.
So here's our game plan. First, we have to really define the enemy. What is this geopolitical threat? Then we're going to bust a very common myth about diversification. After that, we get to the good stuff, the professional secret to controlling risk, the actual tools in the hedging toolbox, how to play both sides of the market, and finally, how to lock in your new empowered mindset.
Okay, let's dive right in. The very first step in protecting yourself is knowing exactly what you're up against. And we're talking about a type of risk that doesn't just show up in a company's quarterly earnings report. But trust me, it can be way, way more devastating.
So this is what the pros call political risk. And it's not about one single company making a bad call. Nope. It's about events so massive, so huge, that they're completely outside of anyone's control. Think about it. A conflict halfway across the world can suddenly cause global energy prices to spike, and that affects, well, everything. Or a new trade war starts, and suddenly there are tariffs and restrictions that just completely crush the supply chains for companies you own. These are the giant waves that can rock every single boat in the harbor, all at once.
And this right here is such a critical distinction. A single company having a bad quarter, that's what we call non-systemic risk. It's isolated. It's a risk you can diversify away from pretty easily. But major political events, they create systemic risk. They don't just threaten one company, they threaten the entire financial system. It doesn't matter how great your stocks are if the whole market gets caught in a hurricane.
This quote just nails it. The stability, the policies of governments, the sovereigns, they create the fundamental backdrop for every single investment you will ever make. You simply cannot ignore the stage on which the entire financial drama is playing out.
So, what do most people do to protect themselves? They diversify, right? That's what we're all taught. But when it comes to this huge, systemic, geopolitical risk, that strategy, well, it might not be the shield you think it is.
This analogy it's perfect. Think about it. A flu shot is great for the flu. It does exactly what it's supposed to do. But it gives you absolutely zero protection against, say, a heart attack. In the exact same way, traditional diversification is designed for a very specific problem. One company failing, not the entire market catching a nasty virus.
So here's the bottom line. Diversification is awesome if one of your companies goes under. But if a major crisis hits and the entire market drops 20%, owning 500 different stocks doesn't help you one bit. You've just bought 500 different cabins on the Titanic. When the whole ship hits an iceberg, that strategy is not going to save you.
Okay, this is the turning point. This is where we completely flip the script. We're going to shift from being passive victims of the market to being in control. See, amateurs hope the storm passes. Professionals? They built an ark. It's about focusing not on the storm, but on your own preparation.
Let's just be brutally honest for a second. You cannot control wars. You can't control what central banks are going to do. You cannot predict what the market will do tomorrow. And you know what? Trying to is just a recipe for frustration and, frankly, failure.
But, and this is the big but, this is where your power lies. While you can't control the event, you can absolutely control your exposure to it. You control your preparation, you control your reaction. This is the fundamental mindset shift from amateur to pro.
This table just lays it out perfectly. The left side, that's what keeps amateurs up at night, endlessly doom-scrolling and guessing. The right side, that's what professionals focus on. So stop worrying about market direction and instead define your exit strategy. Know the exact point you'll sell no matter what. Stop trying to predict the next war and instead control whether you even own an asset in the first place, how you insure it, and maybe most importantly, control your position sizing, how much of your money you're willing to risk on any single idea. This is how you go from being a passenger to being the pilot.
And this right here is the secret sauce. It's the core idea. For the things you can't control in life, like your house burning down, what do? You buy insurance. Well, for the things you can't control in the market, you buy a hedge. It's the exact same logic.
This isn't about some wild speculation. It's about responsible risk management. It's financial insurance, plain and simple. Okay, now we get to the really fun part, the how-to. Let's actually open up the toolbox and look at the instruments professionals use to put this insurance strategy into practice and actually take control of their risk. So inside this toolbox, you've got a whole bunch of cool stuff. You've got ways to limit your exposure, like position sizing, and ways to own assets that actually zig when the market zags. But for today, we're going to focus on two of the most powerful tools: buying direct insurance and learning how to play both sides.
A protective put is the purest form of portfolio insurance you can get. Seriously, think about your car insurance. You pay a small premium every month, right? If you get into a huge wreck, that insurance covers the massive loss. If you don't have a wreck, you don't get angry that you wasted the premium. No, you're happy you didn't need it. A protective put is the exact same concept for your stock. You pay a small premium to protect your big asset from a crash.
So how does this actually work? Let's break it down step by step. First, you own a stock you want to protect. Let's say you've got 100 shares of a company trading at $100 a share. That's a $10,000 asset. Step 2, you look up the available insurance policies, which are called put options. It sounds complex, but it's really just a menu of protection plans. Third, you choose the price you want to be protected at. This is called the strike price. Think of it like your insurance deductible. Let's say you pick a strike price of $90. This means you are buying the right to sell your shares for $90 each, no matter what the real market price is. And finally, step 4, you buy that option. It might cost you a few dollars per share, but that's it. You have now put a hard floor under your investment. If that stock crashes to $50 or even to zero, you have the contractual right to sell your shares for $90. You've taken the scary, unknown risk and turned it into a known, fixed, manageable cost. That's control.
Okay, so that's one tool. Let's grab another really powerful one from the toolbox. Instead of just insuring one asset, what if you could build a portfolio where some parts actually go up when other parts are going down? This is the magic of correlation.
Inverse correlation. Just think of a perfectly balanced teeter-totter on a playground. It's a law of physics. When one side goes down, the other side has to go up. It's the same in finance. By pairing assets like this in your portfolio, you create this incredible stabilizing effect. So, while your stocks are falling in a panic, your inversely correlated asset is designed to rise, helping to neutralize the damage.
This chart shows you exactly what I mean. Let's imagine a geopolitical crisis sends the market plunging 15%. Well, an inverse ETF, which is just a fund specifically designed to be the market's opposite, its teeter-totter, would in theory rise by 15%. The loss in one part of your portfolio gets canceled out by the gain in another, and you can buy these just like a regular stock. By putting a small piece of your portfolio into an asset like this, you are no longer just betting on the market going up. You are now prepared for it to go down too.
So, let's bring all of this home. We've defined the risk, we've busted a common myth, and now you are equipped with professional-grade tools. The final, crucial piece is to really cement this new, empowered way of thinking. And this, right here, is the ultimate takeaway. This is not about having a crystal ball. In fact, it's about admitting you don't have one. We accept that huge, unpredictable market shifts will happen. The goal isn't to guess when. The goal is to have a plan in place for when they happen, so that you are prepared for any direction the market decides to take. So I'm going to leave you with this one simple question. Take an honest look at your own investments. Is your portfolio built on hope, or is it built on a plan? Have you actually acknowledged the reality of risk and built a smart, robust strategy to manage it, no matter what the headlines throw at you next? The choice and the control is all yours.